And hello again. Welcome to the Marc Oslar Retirement Experience. My name is Randy Cook. Each week, Mark and I sit down here and talk through some of the issues that you might be worried about or concerned about or wondering about or scared to death about when it comes to going into retirement, and trying to take some of the mystery out of all that and show you that having that right person that you can help plan through all of those scary tactics can really be an advantage to you. And that is why we want to put you in touch with Mark. How are you doing today, my friend?
I'm great, Randy. Hey, we've been at this for almost 2 years now, right?
Yes. And
I'm loving it.
What's amazing to me is I'm so glad that we do this every week, because there is so much that happens from week to week. Well, I mean, you got weather that's busting out all over. I mean, one day it's 60, the next day it's 25, and then one day it's sunny, and then it's snow. I mean, it's nuts. And then markets all over the place as well. And now we have basketball busting out all over, which is a great time of year, isn't it?
It's fantastic. Oh, everybody! If you tell me you don't like March Madness, then we're gonna have some issues, right?
Have you done a bracket? I haven't done my bracket yet. I'm slacking here. I don't know.
Yeah, doing the bracket's key. You know, you always want to be successful with your bracket, and I am hit or miss. I'm always a 50-50 guy, but yeah, I always work on my bracket early. Get it done, get moving on. You know,
you walk around the office and you give it to everybody, and then some woman goes, I don't know anything about this, so I'm just doing it on the colors of their uniform, and then she wins. It's whatever, I don't know, but yeah, there's an awful lot going on right now, and that's what we really want to do on this show, is really talk about some financial headlines and some things that are going out there economically, but mostly what we want to do is talk about how it affects you, how you are affected by it, and how we can help. So that's the whole idea here. I'm going to give you the website right away here. It's moretoretire.com, and I'll be mentioning that through the show here today. If it's time to talk about your retirement, don't fight that. Let's just get that out, get a date on a calendar and actually talk through it. And we'll talk about that more as we go through here. And you know, Mark, if you take a look at the last couple of years, and we've been doing this show for a little while, it's been really good. The market, I mean, double-digit returns for the last couple of years in a row. And I saw a story from Fidelity, and they said just in the fourth quarter last year, before all this volatility has hit, they had 665,000 people go into the $1 Million Club with their 401ks, which is fantastic. But it also said that those people are really going to struggle right now. Because once you get to a milestone like that, you get into seven figures, you don't want to go backwards. I don't want to go back into the 900,000s. I want to make sure I just go forward. So they go to cash, or they pull all their risk off the table, and they forget about growth, and they say, this number is what I've been shooting for. I got there. I'm good. Is there any danger in that, Mark, that we kind of give up growth? Or if you have enough money, it's like literally putting it under your mattress and you're going to be okay? What would you say to that person who sits down with you and has that attitude?
You know, somebody's sitting down with me and they say, you know what, I'm done. I'm putting it under the mattress. Yeah, we should have a conversation about that, because where's the interest going to come from? Got to make your money work for you. So that's really important. You know, just even looking at kingdom or biblical principles and talking about how you make money, well, you have to actually build assets too. And that's really important. As you build assets and as you grow, and maybe you grow your business, or maybe you have a 9-to-5 and you're running the show, whatever it might be, having income, but having income producing assets are very important. So we discuss what level of risk are you looking for. So the several things that we talk about on the show condenses into one main format, which is preservation, income, and growth. And we stick to that format because it's the truth. It's the significance of what we want to accomplish with our clients. So when we're talking about income producing assets, they're very important. No, don't put it on your mattress. Hey, yeah, you might put it in the bank, but interest rates are dropping. So the question is, if you do want to be more conservative, what could you do with it?
Gotcha. Those three things are so very important, and you don't get all that out of a 401k. I mean, that's a place to grow your money for sure, put money in there, but it doesn't give you that income. It doesn't give you the preservation tactics that we talk about here on the show, because the choices tend to be kind of limited there. So what kind of growth do we need? I imagine it's different different for everybody. But beating the market every year, is that necessary? Can we get by with a 2% or a 3% growth and be really conservative, or should we shoot for 5 or 6%? What is there a common goal that you see amongst people who sit down and plan for retirement?
It's all over the spectrum, to be honest with you. There are people that tell me, oh, well, I'm making 13 or 14%. Okay, well, that's great. That's fantastic. But we're also in historic territory. You're talking about a market that has been up for 17 years that hasn't had an actual correction. And people say, well, what about 2022? 2022 was a short period of time. It was not long enough to be an actual correction. And in addition to that, the S&P dropped 18%, not 20% or more. Now, the NASDAQ was down 33 during that time. But again, we have to focus on what history tells us. That's an important factor, because right now we just keep breaking record after record. So if you're assuming that in retirement you should be making 14 or 15%, you might want to question that rationale and see what's a sensible thing for you to do. Because if you've worked your whole life and you've built up this nest egg, are you looking for some preservation tactics to build off of that income? Well, I would suggest, if that's the case, we should actually have that conversation and talk about, what do we want to preserve, which you worked your whole life for, and what can we have some type of level of risk with this money? This is a very important conversation. If you're within 5 years of retirement, if you're within a year of retirement, whatever it might be, let's have that conversation.
As long as we're talking basketball and doing all those metaphors, I mean, think about it. If you're up by 15, 20 points and there's 2 or 3 minutes left in the game, what are you going to do? You're going to hold on to the ball. You're going to not take a lot of risk. You're not going to take a lot of shots. You're going to work the clock. You're going to be real conservative, and you're going to run out the clock and win the game. And essentially, in retirement, you're kind of thinking the same thing. Your lead is that big number that you've put in that nest egg. Is it $1 million? Great. If it's not quite there, fine. If it's $1.8 million, whatever. And this is your big lead, so there's no reason to risk it all in the last, 10, 15 years of your life.
That's right, because what we want to do is consolidate. We want to get an idea of what you have. We look at the big picture, look at it as a whole, and say, okay, what is a sensible return for us? What's the amount of income we need? How do we prepare for, taxes and inflation moving forward? And truthfully, because of all that, what's to me really important is, if you're getting income, that it has to come from preservation places. Because if you have some preservation tactics built in, you won't worry as much. And that's a really important thing. We have some videos that we put out there for some folks that talk about sequence of returns. Think about if you have a loss in the market and you're taking withdrawals at the same time, how that could impact your retirement. Well, if you take some and put it towards some preservation tactics, how it won't affect it as much.
You're listening to the Marc Oslar Retirement Experience, and you can find Marc at moretoretire.com. I encourage you to do that. Tool around a little bit, go through the website. You'll see the whole process that is right there on the website. There's a place for you to put some information in there if you want Marc to give you a call, or you can just reach out and give Marc a call and get a date on a calendar and start to talk through some of this. Where do I need to be? Well, how much have I saved enough? Am I going to run out of money? Am I headed for a tax problem? What do I do about Social Security? Medicare confuses me. Oh, there's so many questions. Let's get your questions answered. 984-300-1984. 984-300-1984. Or again, moretoretire.com. Just spell it right out. All right. So then when we talk about our money and we have, we always say $1 million because it's easy math for those of us who made it through third grade. And so $1 million, you saved $1 million. How much does that mean to you per month? Okay, that's a big deal. It's not so much the big number, it's the monthly number. So the people at Schroders did a survey, and they said if you wanted $3,000 a month, how much would you need to save? If you wanted $5,000 a month, how much would you need to save? These are the numbers they came up with. For $3,000 a month, you need about $300,000 saved. For $5,000 a month, you need about $880,000 saved. So if you had Social Security and that, you would probably be, in a pretty good position. Marc, do those numbers add up to what you usually see, that if somebody wanted that amount, they would save this amount?
You probably would have something minimally like this.
Okay.
Generally speaking, you want to get an idea of how old the person is, when they want to take the income, and so on and so forth. So there's several different things that, at play here, right? If you're, let's say you're 55 years old, but you're not 59 and a half. Well, how do you pull from qualified money? Well, you can. You'd have to commit to something called a 72T. It's out of the Internal Revenue Code, but that just it talks about you taking equal distributions for 5 consecutive years to age 60. But if you're age 56 or 57 or 58 and you still want to do it that way, you have to still commit to 5 full years. So that's one way you can access some qualified funds before 59 and a half. If you're 59 and a half, we factor it on several other levels, but you don't have to worry about the 10% penalty from the IRS. So again, these conversations need to happen ahead of time so we get an idea of what your needs are now. Let's say you're 55 all the way to 60, then needs from 60 to 65, bridging the gap and understanding what the needs are for the person. Because what we want to do is say, okay, if you give us all this information, we can calculate this and we have a good understanding of what we can tell you we could provide here. But figures wise, yeah, I mean, you got to have a certain amount saved in order to have a certain amount taken off. The question is how much and how are we going about this? So again, like I said before in the past, a lot of times if you don't have any income plan other than Social Security, there are some very high probabilities we might even discuss an annuity or an annuity with an income rider. That could be a real discussion.
So from a person who is, let's just say $500,000, that's what I've saved for retirement. If I were to put that in a CD, I would get this payout. That would be my income. If I were to put it in a bond, it would be this, and I'd have to wait. If I were to put it in an annuity, it would be this. If I put it in a structured note, it would be this. Do you find that people use a combination of all of these to get to their income, or do they just pick the best one? That's going to get me the highest payout. I'm going there.
You're really making me juggle here, Randy. I mean, it varies greatly.
Okay.
It has to do with the person's risk tolerance.
Okay.
So are there some people, some clients that I have that don't have any money in annuities? Yes, there are some clients of mine, they might have some bank money and maybe some brokerage assets and some other things. Get it. But it's never my favorite way because I like to look at some preservation tactics. CDs, interest rates are going lower and lower, and so obviously they're not as effective right now for folks.
Okay.
Same thing, you look at bonds, maybe the rates aren't the coupons aren't high enough for the people to have the return they need off the sum of money they have. That's why a lot of times we have the conversation about income riders, because income riders usually have a higher payout stream, and there's a good chance that maybe you have some decent returns and it holds up the asset a little while. But in order to describe a fixed annuity or a fixed index annuity with an income rider, basically it's you giving the insurance company money. They might provide, if it's a fixed index annuity, they might provide some indexing options that could provide some returns that maybe they beat CDs, just depends on the market and how it does, right? But they also provide this income rider. Keep in mind, this is a deferred annuity, not an immediate annuity. So it's not going to be considered the same exact thing as an immediate annuity or what people would call a pension. But an annuity is a pension in the sense that being a deferred annuity, you can add this income rider, and then it'll tell you based on the age that you turn on income what that income would be for you or you and a spouse. And generally speaking, that can help us with the law of large numbers of figuring out, can this work into your retirement portfolio as part of your income in retirement? This is kind of important because if you don't have an income plan, it's good to add something like this to your income plan so that maybe we can work on some of the other areas too. There's also areas where you might have higher distribution payouts, and you want to check on the volatility of those types of funds. And then you talk about structured notes. Structured notes that's another avenue we discuss, and that's where you let a bank borrow your money, and then they tell you certain parameters of how those figures pay back to you. It's an alternative investment, but again, there are also usually some safety measures there. And when I say that, I mean preservation tools where maybe there's a potential of a protection of 20 or 30%, just depending on if they call it a buffer or a barrier. Those are things we talk about in the office because they can be complex and confusing. I want to keep it simple, Randy. I want to keep it simple.
I love the idea that you bring them all up, and it might be news to people. They never heard anything like that, and they all think in their head, stocks, bonds, mutual funds. That's what I know. My savings, my 401k, that's what I know. And there are a lot of other options out there, vehicles, so to speak, that you can use in your retirement. And to sit down with Mark, he can introduce you to these options and things that might be right for you. Give him a call. Let's get a date on a calendar. And as I say every week, let's do the math on your retirement. Whether it's a couple of years away or you're kind of thinking in your head, gee, work is getting to be a drag. I wonder if I could retire. Yeah, this is that time. This is the time to have that meeting. Moretoretire.com is the website. Moretoretire.com. There's a place on the website there that you can put a little information in. Mark reaches out to you, or you can reach out to Mark. 984-300-1984. 984-300-1984. Okay, so the people from 24/7 Wall Street did an article there, and they had a guy who wrote in, and he said, I did the math on my retirement, and I'm going to get $1.5 million from Social Security. All right, full stop. How is this guy going to get $1.5 million in Social Security? Is that common? What's the math on that? Let's just talk there for just a second here, Mark.
Good luck. Okay.
Okay, got it. That's a big
start.
number.
Yeah. I mean, seriously, Randy. So here we are. A lot of people are thinking. A lot of times they think, whether I max it out. There's so many different ways to take Social Security. You can take it at 62 if you're at that age where you're allowed to take it at 62. It could be 63 or 65, or 67 is usually age full, or sometimes 66 and 8 months. And then there's 70 where you're maxing the heck out of it. And that's where people think, if I live long enough, boy, am I going to make a lot of money, right? But when I look at the math of understanding Social Security, I do not want you to focus your retirement years on this. You brought this up on a previous segment, Randy, and we talked about this in detail, how, if they don't fix the trust fund for Social Security, how originally by 2033, but now by 2032, it would be exhausted. And they're guesstimating. I'm going to throw a little term in there. They're guesstimating that everybody's Social Security would be reduced by 28%. Okay, well, as a financial advisor, a lot of times I tell people, well, let's just chop 25% off the top of this thing, and let's figure out the rest of your situation. So this way we don't get caught in a rainstorm, right?
Yep.
But for him, he's obviously thinking, I'm going to max the heck out of this thing and get as much money as possible and live a long time.
Well, if this guy was a real high earner throughout his life, and he's going to get the top Social Security benefit, and he's going to get it for 25 years, okay, I get it. $5,000 a month for 25 or 30 years, you add that up, $1.5 million. But there's only a very small percentage of people that get the top Social Security payment, like 2-3%, something like that. But the fact of the matter is, Lawrence Kotlikoff, I know you don't know that name, but he wrote a book about Social Security, and in it, he basically says that your Social Security decision is one of the most important things that you're going to talk about in retirement. And I don't necessarily agree with that. You just said it, that it's in complement with everything else that's going on. So, you could say, I'm going to wait till full Social Security age to take it, but you got to have it working in tandem with an income plan and everything else. And isn't that really more of the key here to retirement planning?
Well, of course, because let's just say, for example, this guy had an age 70 Social Security of $5,000 a month, right? Well, he's definitely planning on living over 20 years to get that 1.5 million that he's talking about. Yeah. Right. And that's not a plan. You got to plan appropriately for your retirement. Otherwise, you're going to plan to fail. And we don't want that to happen for our clients. We want our clients to say, okay, we are saddled up and we're ready for this ride. This is what we're doing now. This is what we're doing in 3 or 5 years, and this is what we're doing 3-5 years later. During those 10 years, we may throw a little curveball and say, we want to adjust this, we want to switch this, we want to change this. That's a part of what we do. We are constantly making adjustments and changes because it's necessary in retirement. So if you come to me and say, set it, forget it, If you hate change, well, you're gonna have to get used to change, because in life things change.
Right.
So saddle up. Let's get on this horse and let's work together. So for me, I want to meet you. If you've got 5 years or 10 years left before you're retiring, then let's have a real conversation about where you want to go. If you are already retired, let's have a real conversation about where you want to go. I had a gentleman call me the other day, and he just had a question about what I mentioned about what if you had to sell an appreciable business or appreciable real estate property. And I said, yeah, there are other things out there other than the Delaware Statutory Trust, other than the opportunity zones. There are other things out there, and I know folks that I can refer you to. There are so many things that we can do here. We always want to bring in the experts, the CPAs, the attorneys, of course, that cross the T's and dot the I's. But this is what we do. We want to be a part of everything that we can help you as much, especially on the tax efficiency side of things. Again, we involve the experts and the pros, but we're here as financial advisors to help as much as we possibly can for our clients on so many different levels. And when people ask me about fees, well, I'm sorry, our fees are not going to be the cheapest. But you know what? You're working with the best. We are the best of the best. So we look forward to providing you good information and helping you.
You bring up such a good point that every retirement is going to be different. Maybe you do have a business that you want to sell, and you're looking at the timing of that. That's going to fund your retirement. How does that work? That's very different than somebody who walks in and their whole life they've been working for other people, and they've got a 401k and maybe even a pension or something like that. Your retirement planning is going to be different than everybody else. That almost goes without saying. Give him a call and let's sit down and talk through the specifics of your retirement. Social Security is a part of the income planning conversation. That is what's coming in. Do we have to push that to 67? Do we have to push that to 70? Could we do it at 62? What are the ups and the downs of that? There's all these decisions, and all of it has different consequences. Let's get it all out on the table. Give Mark a call, 984-300-1984, 984-300-1984, or the website is more2retire.com. Just check that out today. All right, now this next story is for a bunch of my radio friends, because I've got so many friends that look at me and go, I'm never going to be able to retire. I'm just going to work till I die. I've heard this so many times. So the people at TIAA did a study just for you guys out there who say, I'm just going to have to work till I die. They found that nearly 2/3 of Americans are kind of feeling this way. They don't think that they can retire even between the ages of 65 and 70. They plan to work until they physically cannot. And if you take a look at what the numbers are for people working later and later, they keep on going up. Years ago, 1987, only about 11% of people over 65 were working. Today, that's nearly 20%. And workers over 75 are the fastest group of people working today. That's pretty crazy. But I want to ask you this. If somebody came into you, Mark, with that and said, Mark, I believe I'm going to have to work till I die, or I just can't stand up anymore. I can't sit at a desk. I can't be the Walmart greeter anymore. You go ahead, you click all you want to on that calculator, and we'll see what happens. And then you do, and you go, guess what? You can retire. Has it happened to you? Have you surprised people like that?
Of course. I mean, folks will come to me, in general, I want you guys to know out there that the bottom line is, if you come into my office and you don't think you can retire, you got to prove it to me, okay? Because I might be able to prove it to you that you can. And that's the point, is you might be worried about it, or you might be worried to share something with me very intimate about some debt or something else that might be going on. Well, we're private. The information you provide to us is completely confidential, and our objective is to help you. We're not going to sit there and tell you, oh, you got to do this or you got to do that. No, everything is informational and everything is transparent. So when we share information with you, it's based on what we've seen with other people and how we believe, based on our years of experience, we can help you. And I think it's really important to understand this. So let's say, for example, you have a TIA annuity out there. You were, you worked for, a hospital, or you worked, as a teacher or whatever it might be. I have come across many people that have had those. I want to tell you about something you might want to know a little bit more about. I think they have a good annuity program. you can usually annuitize the annuity with TIA and it'll provide some type of lifetime income. But I want you to know that when you do that, that is an immediate annuity. Okay. If you want to see something different or you want to compare it to a deferred annuity with an income rider where the asset is still considered your asset with a lifetime income rider, we can do that at our office too. And I think it's important for people to understand these things, because if you look at these tactics and understand, where the buckets of money are coming from, we might be able to turn around and tell you, hey, you might be 70 years old and say, I can't do this. And I'll say, come on in, let's talk. And you say, wait, are you sure? And I'll tell you whether I believe so or not based on certain parameters, certain figures, certain payouts, certain structures of how you do things. As long as you're being honest and telling me about your income and expenses, and I'll grill you about it, because I want to know about other expenses you might not be thinking about too.
You're listening to the Marc Oslar Retirement Experience. Online, it's moretoretire.com. Moretoretire.com. Spell it right out. There, I want you to tool around a little bit, learn more about Marc, learn more about the process that you go through, and give him a call and get a date on a calendar. Go through this process. We do it at no cost or obligation. That means we sit down and really crunch numbers and say, here's what's coming in, here's what's going out, here's what you want to do in retirement, and then let's look at the numbers. Is there a gap there? Gap that you have to fill? Let's figure it out together. 984-300-1984. 984-300-1984. The website again, moretoretire.com. And Marc, while they're at the website, they can see your steps to more. So let's kind of go through that a little bit as somebody, gives you a call and says, okay, Marc, I'm going to retire in a year or 2 years, and I've got some time to make some adjustments if I need to. What are we going to do, and how are you going to get me there? What is your process?
Sure. So in our process, sometimes we just want to run a report for you to get an understanding of what your investments are doing for you. So a lot of times people go to my website, moretoretire.com, and that's a TO, not number 2. So moretoretire.com. Scroll down to the bottom of the screen, you put in your information. The information will come to our team. It'll tell us who wants us to contact them. And basically we'll say, hey, if you want to use our secure upload button on our website, which is in the top right-hand corner, you just tell us in the information at the bottom that you sent that stuff to us, and that'll come straight to our secure upload, and we'll take a look and we'll run a report for you. The report will tell us several things about your financial situation, and then we can come back together and talk about it and see if it's lining up with what you're trying to do in retirement. So we call that the treetop view, and we look at 401ks, we look at other brokers, whatever it might be. We look at annuity statements, whatever you've got. We ask you to bring it on in, and we'll take a look. And we want to do is get an idea of that treetop view and what you've worked for your whole life. And then we'll move on to discovering retirement desires and dreams. And as we do those things, we put all this stuff together. And a lot of times after a couple of appointments, people understand it's really okay to commit to me, because then what we're going to do is we're going to diagnose exactly where we're going to put the money at that point in time. Everybody has financial products. Everybody has financial features. This is not a one-size-fits-all thing. But what we can tell you is it's customizable. And we have enough things that we can work with. And the best thing you get is my brain. I've got a good brain for this, and I love sharing it. So this is what we do. And then as you become a client, we work with you, and then eventually we make some ongoing adjustments and switches and changes, because that comes with the course of what we're doing here. And you're always going to get ongoing support. This is how we work with folks.
Well, I think that boiling it right down to its most simple statement is this. You know that you can make it on $6,000 a month now. You want $6,000 in retirement per month. And Marc, how are we going to do that? And that's really a great place to start. Give them a call. Let's get a date on a calendar. Moretoretire.com is the website. Spell it right out, moretoretire.com, or 984-300-1984. 984-300-1984. We'll take a quick break. Come right back with more of the Marc Oslar Retirement Experience. How many of you think taxes will go up in the future? And if they do, who will be hit the hardest? Most people say millionaires. But what about you, headed for retirement? You've been saving in that 401k or IRA, and that money has never been taxed. And Uncle Sam is looking at that account like it's a big, juicy steak. What do you do about it? You can call Marc Oslar. He believes a financial plan is not a retirement plan without a tax plan. If you don't check off this important box, you could see your Social Security check go down and your Medicare premiums go up. Fund your retirement, not Uncle Sam's. Call Marc Oslar today at 984-300-1984. 984-300-1984 or online at moretoretire.com. Welcome back to the Marc Oslar Retirement Experience online, moretoretire.com. Just spell it right out. Learn more about Marc. There's actually a place right on the website there that you can ask a question. You can say, hey, I'd like to talk about my retirement, put a little contact information in there and get the ball rolling. Or give Marc a call at 984-300-1984. So I have my nose in the headlines, and I'm looking at financial news all the time. And, you know, there's certain things that happen in the economy that kind of forecast a recession. You talk about markets going down for periods of time. You talk about people that might be getting late on their credit cards or using their credit cards a whole lot more. Then there's this, that Vanguard has found that a lot of people are dipping into their 401ks. And I thought, well, that's not a good sign. And then I read a little bit more, and it said basically they're taking out about $2,000. So that's not dipping in for a huge emergency. To me, that means that's dipping in because they need a little to get them through to the next month. A big bill came in, something happened, a car repair took place, and they're using their 401k kind of like a bank account. So that's really what I want to talk about here, Marc, is people who go in. And I mean, I've done this. I got into trouble with credit cards, and I had to go into my 401k years ago and get myself out of it. I'm not proud of that, but it is something that I had to do. Do you find that people are doing this? What is the danger? What is the long-term ramifications of dipping into your 401k and using it like a piggy bank?
Sure. So you talk about two different things: hardship withdrawals versus borrowing money, right? Mm-hmm. So hardship withdrawals, there's that little limit you can use, and the IRS will approve it through the 401k provider. You just got to make sure that it's coded properly, and then boom, you've got your money that you need. But that is pulling some money out of your 401k plan. If you're borrowing money, then you're paying interest on it coming back. So a lot of times you make this repayment plan over a certain period of time till you get that back off. And that, of course, also comes to you tax-free because it's a loan, obviously. So, but again, if you end up getting fired or laid off, or you leave the provider and you still owe like 10 grand, then keep in mind that when you go ahead and you roll that to an IRA, you're going to have to pay that. So again, that's going to come up too, and that's taxable. So these things are important to understand. Is this the most sensible place to take the money? Well, there are also some advantages. Okay. First-time home buyers have the ability to dip into a 401k. Okay. That's a great advantage. And sometimes they're eligible for the FHA loans and stuff like that. It's never off the table with me when somebody wants to borrow from their 401k. It's actually a viable thing. The question is it the right thing at the right time for that particular person? And these are the questions we answer. But I've had people use me as a financial coach before. They call me and they have some other debt problems, and they'll just ask me about them. And I just start looking over everything, and I try to guide them in the right direction to get them back on their feet in those areas, because we've all done it. We've all been in these types of situations, and we don't want to go back there again. So my objective is, hey, what's the good money? What's the bad money? What's the interest payment here? Is this going to affect or push back how long it's going to take for you to retire? All of these things are very important to understand. And so we have these conversations to make sure that you are putting yourself in the right position for retirement at the right time that you want to retire. Now, if you tell me you really want to retire at 59 and a half, I might come back to you and tell you the only way you can retire at 59 and a half is if you take a little bit of risk. That's a possibility. Or you might take it with no risk and have to retire at 62. Again, we have to keep in line insurance, Medicare, all this stuff matters, Randy.
So taking money out of that 401k, even as a loan or something, or a hardship, there's one thing there. But taking it out simply because that's the only place where you have money and you don't have an emergency fund, you're kind of robbing from your future, aren't you?
Yeah, and that's part of it is the sense that we've got to build up these areas where you have some safety measures. Just like when I go do an annuity for a client of mine, annuities aren't meant to be liquid assets, okay? So an annuity has a strategic purpose behind it, and so you don't want that to be something liquid that you're dealing with there. So the same thing here is you need to build up those places in the bank. You need to build up the money market. You need to have these slush funds that are available for you in case these things occur so you don't have to pull off your retirement vehicles.
You're listening to the Marc Oslar Retirement Experience, and online it is more2retire.com. Spell it right out, more2retire.com. Tool around the website a little bit, learn more about Marc, and give him a call. And let's sit down and talk about your retirement, the math of your retirement. Actually get down to some planning here and figure out, what's coming in, what's going out, what do you want to do? And then are there any things that got you worried about the future? Is it the stock market? Is it taxes? Is it long-term care? Is it whatever it is? Let's get it all out on the table. 984-300-1984 is the number. It's a no-cost, no-obligation look at your retirement. 984-300-1984. Well, if you watch sports at all on the weekend, you're going to be watching a little basketball this weekend. I watch a lot of golf, and you're going to see lots of commercials for financial institutions. You're going to see whales going up and splashing in the water and stuff, and that's Pacific Life. And Pacific Life just came out this past week with a big headline, and the headline was this: annuities are back. And I looked at that and I go, really? Where have you been? All right. So I don't know why they did this. Do you think it's almost like a public relations move? Because I remember when BlackRock came out, and they're all about risk, and they're all about stocks, and they're all about equities. And then they came out and said, hey, how about annuities? And I go, well, you guys are obviously using them too now. They've been breaking records for the last 5 to 7 years, Mark. All these baby boomers are using annuities as income products in their retirement and for other reasons as well. Why would Pac Life come out right now and say, hey, annuities are back?
So let me share with you a little story.
Okay.
About that will this will clear some things up, Randy. So I made a strategic error, okay? I decided for Lent I would give up sugar, okay? That means like added sugar, right? I can eat fruit, stuff like that, but any of these added sugars or refined sugars?
Processed sugar, yeah, get rid of that.
Yeah.
Okay.
Well, Randy, I'm a huge Oreo double stuff fan or Oreo fan in general, right?
Yeah.
So years ago, they used to make these sugar-free Oreos. Well, guess what? They're back.
Oh, okay.
That's right.
Are they any good?
Yeah.
Really?
I had the double stuff. I had it. Is it as sweet as an Oreo? No.
Okay.
But honestly, Randy, if you want a substitute, it's good.
Okay.
Well, guess what? They're back. Annuities have been here, okay? Pacific Life, wake up. You just weren't in the right spectrum. I know you've been selling fixed indexed annuities for a while, but you're not top of the list. We know who the top providers are. We know who provides some of the better products. Okay. So that's important to understand in the context here. And yes, if you want to try sugar-free double stuffed Oreos, go ahead. Go to your local food line or something. They're there.
All right. Well, at the same time, as I look at an annuity, it has a bit of a black eye out there because certainly we'll just name them. Fisher Investments comes out there and they've got commercials that talk about we would never sell anybody an annuity. And they have a reason for that. And there are plenty of things that you can learn about annuities where there's good and there's bad. But, Mark, if you look at any investment product, you look at a bond, there's probably some positive and negative, some pros and cons. If you look at any of the products out there, if you look at being in the market, there's pros and cons. So there's pros and cons to everybody. You just have to kind of figure out with your financial advisor what is right for you and what the risk level is right for you and what the benefits are. It's just let's look at all the options and figure out what's right.
If you had an annuity that you bought back in like 2018, 2019, 2020, even 2021, why don't you just pop in my office and let's talk about it? Because interest rates were so low that these products were priced differently. And that could be some of the biggest issues too. So let's just consider that as a possibility. right? Because now the products are priced a little bit different. Now that can change in the next 3-6 months. They have changed a little bit already. I was able to lock some people into multi-year guarantee annuities, MIGAs. They're also just generally a fixed annuity with a fixed rate of return for a certain number of years, kind of like a CD type of annuity, right? I was able to put people in some fixed index annuities that have these family endowment riders that rolled up at a really nice percentage too. They'll probably change in the near future as well. But what I will tell you is that there's some annuities out there that are attached to some indexes that have been pretty darn effective over the last 3 years, as opposed to other products that might not have earned. And so if you're not earning, you might want to have that conversation with me, because there are ones out there that do. And sometimes when I have one that's just not performing, we can usually reallocate. But if we can't reallocate, we'll switch it out, because we want to make sure the client is doing what they're supposed to do now and in retirement. So again, annuities, there's so many different features, so many different thought processes. But if you're looking for good, sensible growth, an annuity could be a right fit. If you're looking for preservation tactics for the good, sensible growth, it could be a right fit. If you're looking for an income rider as opposed to an immediate annuity, it could be a right fit. If you're looking for something as a long-term care alternative, there could be living needs benefits attached to the annuity. That could be a benefit too. There are so many different things, but you have to have liquidity. Liquidity is key when you're doing annuities. So you have to have other sources of money, other things spread out, because this is a very serious thing. When you buy an annuity, it's for strategic purposes. I understand Fisher Investments, they only want to be in a fiduciary capacity. Well, we want to be in an insurance and a fiduciary capacity, meaning brokerage and insurance. We want to provide as much as we possibly can for our clients to provide them with preservation, income, and growth in retirement.
I heard a great story about annuities that kind of brought it to life for me. And it says, say, for instance, you're going into an operating room, you're going to have an operation, and they wheel you in there, and you're kind of looking around as you usually do at all the instruments and everything that's there. And they're about to put the thing over your nose and have you count backwards from 100. And the doctor walks in and he sees all of the instruments out there, and he goes, "Oh, that plate right there, get it out of here. I don't use those. I will never use those." And so 1/3 of the instruments gets taken out of the room. So you just about going under go, wait, what if you need those? And that is the way I think that people should look at that in retirement, as you go to your meeting and say, I want to see all of the instruments that are there. I want to look at everything that's available to me. Don't yank these away from me before I can even consider them and talk through them with you. Give Marc a call. Let's talk through all your options for retirement. Whatever's out there, how to get your income, how to get your preservation, how to get your growth. Talk about taxes. Here's the number. Here's the website. 984-300-1984. 984-300-1984 or more2retire.com. So we talk about risk in retirement. How much of that money do you want in the stock market? And as you get into your 60s, 70s, and 80s, you probably want a little bit less risk. Well, what if you hated all risk? Kiplinger has an article for those of you who hate risk. You hate the stock market. They say if you don't like the stock market, but you like something a little sexier than a CD, they suggest these two things for you to look at. And you've mentioned them, Marc: structured notes and buffered ETFs. Now, I don't know that a lot of us know what that is, so let's talk about this a little bit. Structured notes, what is that, and who uses them, and what are they for?
Sure. So give an example of some of the ones that we like to use in-house. I'll just give you an idea of what one might look like. Let's say, for example, you wanted the bank to borrow your money, and they wanted to pay you a certain percentage return based on what you're offering. Okay, so probably the biggest growth one we have is a major bank, right? It's an uncapped strategy, for example, and it's a 2-year period of time, and the parameters change all the time. But in this particular case, it's called a dual directional note. Let's say the bank borrows $100,000 of your money, okay, and they give you S&P, Russell, and NASDAQ. What they're going to tell you over those 24 months is they're going to tell you, we'll give you the least returning of the S&P, Russell, and NASDAQ over 24 months, and then we're going to do something called a buffer. A buffer is where the bank will take the first amount percentage loss of the loss. And in this case, it would be 20%. So if the lowest returning ends up going negative 25 over that 2-year period of time, the person's net loss would be 5%.
Okay.
However, this one's a dual directional note. So if the lowest returning one ends up being like negative 18, they would actually get a positive 18% return for that year. So basically, you're letting the bank borrow your money, and they're giving you some indexes and telling you what it should return. Now, when the market had some historic returns over previous 2 years, people had historic returns themselves too, because again, these things were uncapped for the growth, and so it's a way where people had some buffering, which they would just call as a preservation tactic. And that's an example of a structured note. There's several other ones. There's coupon ones that might pay a higher percentage coupon than a bond would be. Again, it would be based on whether the index is positive or whether the index reached that level. And so the banks will tell you these types of things, and they're usually the banks, they like to call them the too big to fail banks. I'm not going to say they're too big to fail, but they call them too big to fail.
Gotcha.
Does that help a little bit, Randy?
A little bit. Okay, I'm getting it. Okay, so the other one that they mentioned is a buffered ETF. So tell me a little bit about that.
Yeah, so an exchange-traded fund is a little bit different than a mutual fund in the sense that you can kind of trade it like you would a normal stock or index, in the sense that you're trading it, we do block trades, so sometimes they take a few hours when we're executing them, but it does not have to be end of day where you do with a mutual fund. So that's how an ETF will work. And if it's buffered, we just talked about buffering, that means in this case, that particular fund will take the first however percentage loss. In this particular case, we were looking at some buffered ETFs, and they were around 15, right? So in this particular case, they would protect up to a 15% downside risk in that scenario. Well, that's not far off different from variable annuities that have something called a registered index-linked annuity. Some people might know about those. They have buffers as well. So that's a similarity. But usually buffered ETFs usually have a cap on their growth too as well. And so that's also the pullback feature. But are they sexier than a CD? Yeah, I would say that both options are definitely the ability to have better growth potential. So I guess you would call that sexier.
Well, I think if you don't like risk, you can still be in the stock market, and there are places within the stock market that have limited risk. You don't have to be a high-flying hedge fund or something like that, or going into Bitcoin and crypto and all that kind of stuff. There's different risk levels in different places of the market. There's different risk levels at different financial vehicles. And to sit down with Marc and talk through, hey, that looks kind of interesting to me. It's a little bit better than a CD. Okay, I kind of like the idea. Sit down, talk through all of that. That comes with an appointment at no cost or obligation. Sit down, talk to Marc. It's 984-300-1984, or use the website, which is moretoretire.com. All right, so Marc, if I were to ask you this heavy financial question here, are you into Star Wars or Star Trek? What would be your favorite?
Oh, that's so funny you asked me that. As a kid, I loved them both.
Yeah.
So I used to watch Star Wars and Star Trek movies. Obviously, the Star Trek show, I watched a little bit, but I wasn't a huge fan. I was more of a Star Trek movie when I was a kid, and Star Wars always loved. I love them both, and there's reasons behind it. But what was interesting was when I was in college, I went to Barton College in Wilson, North Carolina. It used to be called Atlantic Christian College, so they technically were still a Christian college. So you would have to take some religion classes. You would also take some Christian classes. And there was one summer that I did a Book of Romans study, and that was that particular class was all in the Book of Romans and how it would link to certain movies. And one of them happened to be Star Wars. And I found that really interesting, and I really, really enjoyed how they kind of paired together.
Well, this article that I have in front of me actually does go toward finances, and it says, when you're in retirement, you have to be a little bit more Spock than Scotty. Okay, so Spock was the logical thinker, the emotionless person. Scotty, a little more excitable. I'm giving her all I can, Captain, and the alarm would be going off, and he'd be saving the day. So I wanted to ask you this: what are the triggers? I know that there are probably people that approach it. Everybody's different. People approach things differently. There are probably people that approach retirement very calm and they're very conservative and very logical thinking. And then there's people who get pretty excited about things. What are the things that you might get a phone call and say, Mark, are we okay? Because things happen in the headlines, things happen in the market. What gets people shook, like Scotty?
The market. Oh my gosh, it's the market every time. And people get nervous about several things. They'll call about the market money. Oh my gosh, do we need to do something? Should we switch it out, put it in the money market? Look, if you really want to switch it out, put it in the money market, I'm not going to stop you from doing it. But I probably would recommend maybe we get maybe a little bit more conservative. Maybe look at a structured note. Maybe look at something like that might have some buffer or barrier that you feel like it gives you some extra protection. Now, if it's fixed index annuities, they get nervous because they're like, oh my gosh, is my money going to make money because the market's dropping? Well, I had a conversation with a guy the other day, and we have some indexes out there that could potentially make money in both markets. And it's really important to understand what you're in and how it applies to your situation. But if we put together a plan, it's based on all the parameters, whether we have a correction in the market or whether we're having a huge market. Our objective is to give you retirement planning without the concern of what if the market corrects. So if we've done our job correctly, then even though you might get the beam me up Scotty nervousness, I can give them the old gentle Spock, it's okay, because at the end of the day, when we have retirement planning that we're doing with our clients, we want to make sure that based on the decisions we make, there is no emotion involved.
I always admired Spock with that whole mind meld thing. I thought that was pretty cool.
Oh, yeah.
He could take people's pain away and all that kind of stuff. You're listening to the Marc Oslar Retirement Experience. Online, it's moretoretire.com. To sit down and talk about your retirement, no cost, no obligation. Let's just have a conversation. You are concerned. You got some things that are on your mind, whether it's markets or taxes or Social Security or healthcare or long-term care. There's just a whole bunch of stuff that's out there that's kind of misty out there in retirement. And you just wonder, am I going to have to deal with it? How much is it going to cost? Did I save enough? There's lots of questions. Let's get your questions answered. 984-300-1984. Pretty simple. 984-300-1984. Give Mark a call or use the website, tool around, learn more, moretoretire.com. There's a place for you to put some information in there, and Mark will reach out to you. The main thing is, let's get the conversation about your retirement going. Start to understand what you need coming in, what's going to go out, and have you done enough to save for the life that you want to build in retirement? If not, if there's a gap there, let's get working on filling that gap as soon as possible. 984-300-1984 or moretoretire.com. Have a great weekend. We'll see you next week right here on the Marc Oslar Retirement Experience.
Insurance products are offered through the insurance business Marc Oslar Retirement Experience. Marc Oslar Retirement Experience is also an investment advisory practice that offers products and services through Impact Partnership Wealth LLC, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by Marc Oslar Retirement Experience are not subject to investment advisor requirements. Investing involves risks, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying ability of the issuing carrier. This radio podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be considered as advice designed to meet the particular needs of an individual situation. Marc Oslar Retirement Experience is not permitted to offer, and no statement made during the show shall constitute legal or tax advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein are provided by third parties that have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Marc Oslar Retirement Experience. Market Guard is a firm that provides investment signals as well as portfolio allocation recommendations for a wide variety of model portfolios. Market Guard does not offer advice or enter into fiduciary relationships. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.